Hi everyone, welcome to my YouTube channel. My name is Tabitha and today we are going to talk about price to sale ratio. So I've been working on this video for a while now because I was busy doing some other stuff. So price to sale ratio or PS ratio is one of the ratios that the investors are using to evaluate companies and to decide whether the company is overvalued or undervalued. They also use it to compare two companies in the same industry. So this is a very important ratio when it comes to investment. So other people can use the PE ratio, other investors, they also use the PS ratio. But what is all about PS ratio? If you're new to this channel, please subscribe for more videos and I will appreciate your business. So let's look at the agendas of today. It might be a long video, but I will just run through it really quick because we are just passing few points here and there, and you applying this concept by yourself and see if it works for you or not is the most important thing. So now let's look at this agenda. So what is the price to sale ratio? Why is it important and how it is calculated? And then recommendation and limitation of this price to sale ratio. So we'll go through it really quick. It's not going to take very long. Just run through it. It might not even take like more than 10 minutes to really finish the whole things. We are now really going to focus more on the calculation method because these days people can easily use apps and to calculate the whole amount and get the value, the final product, and they use it. So the interpretation is what really important, not the calculation. I'm just using the calculation to just make the full package of the price to sale ratio. So now let's look at the price to sale ratio. What is price to sale? So like we said before, this price to sale ratio is used to compare companies. Is also used to see if the company is undervalued or overvalued. So it is what investors are willing to pay compared to revenue of the company. So if you look at what you're willing to pay compared to the company revenue, and then you can now get the price to sale ratio and this value, you can now see if the company is overvalued or undervalued. So as we move through this video, we will get to understand more on how to interpret that value called stocks versus revenue. Okay. So more on why is it important. So what is price to sale ratio? We are still giving more information on price to sale ratio. And all this point I've already talked about. This is like company to tell you the investors. It tell investors if the company is undervalued or overvalued. And it's also talk about like if you can use it to compare two companies in the same industry. So why is it important? So more information on this is for investors to avoid placing unrealistic valuation on the company. So at the beginning, I told you that it's used for evaluation alongside with other ratios, right? Other ratios to come to a final decision on why you are putting your money in this company and whether it's worth it for you to keep your money in this company. So when company experience period of early growth, investors place unrealistic valuation on the company. And when the value drop below their expectation, investors panic and sell. This is a common scenario in the investment world. So when people are really doing the guesswork of just saying, oh, this company, people are talking about it. This company, a lot of people thinking like it is going to the moon. So without really putting in the data that is needed, so the information that it should be used to make your final decision, then you end up being the loser in this case. So that's also why it is important for you to know the PS ratio alongside other ratios for you to make your investment decision. Why is it important? So this one is also used to compare two companies in the same industry. I think I've repeated this point so many times. So like for example, if you have CIBC, PMO, and then you want to decide which one, you look at the price to sale ratio and see which one is undervalued and which one is overvalued. Which one will cost you if you're looking at the price, or maybe you want to put less money in the company as compared to the revenue that you make, and then you can use PS ratio to compare them. McDonald's and Starbucks. So those one you can also use PS ratio to compare them. And the company that has the lower PS ratio is better when you are using PS ratio to evaluate. So the lower the PS ratio, the better. So you pick the one that has the lower PS ratio. And as we said before, you cannot only make your conclusion based on that. Maybe you have to look at the whole picture. Why is it important? So we have so many points. So I think this next 3 point will sum up the whole thing and might make sense for you to understand the price to sale ratio, right? This one will give you the more understanding. So if your price to sale ratio is 1, right? It's always presented as 1x, right? So this means that you're paying $1 for every $1 of sale the company make or revenue. So it's just like equal. But if your price to sale ratio is 2, it means that you are paying $2 for every $1 of sale a company make. So this company actually is overvalued. If you calculate the price to sale ratio and the price to sale ratio is 2, and you are paying 2 for $1. So the company is giving you a value of $1, but you're paying $2 to buy this company. So this is the amount that they include in your price of the stocks that you're buying. So it's expensive. Now, let's look at the next point. So the next point is, if your price to sale ratio is 50 cents, no, if your price to sale ratio, if your price to sale ratio is 0.5, that is, you are paying 50 cents for every dollar of the sale the company make. So in other words, this company is undervalued. It's undervalued. Undervalued. So this is a good company. It's giving you more value in terms of revenue, but you're paying less. So that's what it means, is undervalued. So some good company that is undervalued, you hear people saying, oh, these are good companies, but they are now undervalued, so I'm going to buy them, right? So it means like they are cheaper now. You can afford them now, but it will still give you the value that you need. So the revenue will still be there. Yeah. So that's what it is. So now let's do the calculation. So the calculation will just run through it because it's not that very important. These days people use apps to just get numbers. They feed everything inside and give out the number. So it's just for the whole picture of price to sale ratio calculation. So we use 2 methods. One is market cap over the yearly revenue. And then the next one would be the price per share over the revenue per share. So this method, you will just go to Yahoo Finance, type in PMO.to, and then once you get that, you will get this information. From the summary, you will see the market cap here. So you have it here, it's 97.377 billion. And then the next part, you will go and check the yearly revenue. So the yearly revenue is not the quarterly value, it has to be for 12 months. So now let's go and look at the yearly revenue of the company, and we will come and do our calculation. We interpret the PS ratio or PMO at this point. So we have market cap over yearly revenue. So that represent one method of calculating price to sale ratio. Now, let's look at the value that we have. So what we are looking for is the yearly revenue now. We already got the market cap. So for you to get the yearly revenue, you have to go to income statement of that company. So you come here and you have the income statement, and the revenue is 31.41 billion. So this is the revenue, and it means the TTM is not quarterly amount. The TTM mean trailing 12 month. So it's for the whole 12 month that was reported in the last period that it's gone. So that's the amount. So now go back and put all the numbers in, and you get the PS ratio. This method of calculating is good for people who are still student. Maybe you can apply it when they ask you to calculate price to sale ratio of this company, and you can get it. It's very easy. So you just get the market cap of the company and the yearly revenue and divide it, put your number there, and you can now interpret it and see how it is, whether this company is expensive or it's not expensive. So at this moment, if you get the price to sale ratio, that is that value, but in the future, you see the price ratio has reduced, it means that company is now undervalued. So let's see. So we have that one and we have this one. So when you divide them, now you get 3.009. So 3.09x. So that is the PS ratio. So the PS ratio means you pay $3.09 for $1 of the revenue the company make. So this company is very expensive. So maybe in the future, if the PS ratio is $2, is 2x, it will mean this good company is undervalued. And this is the time where investors who are investing long term buy, because they will pay cheap and they still get the value that the company give, right? So this is the 97.377B and 31.41B. So you get 3.09x. So this is the price to sale ratio. And as I said before, you're paying $3.09 per $1 the revenue the company make. Okay. So let's go to the next method. So the next method will still give you the same amount, but it's just alternative, just in case. But the next method sometimes can give you error because it's a long process. The first method is much easier, much quicker. So I just did this one to really see that the first method we did was correct. So price per share over revenue per share. Now go down and see what happened. So for you to get the revenue per share, you have to take the revenue, which is for the whole month, the whole 12 month, divided by outstanding shares. So the revenue per share will be 31,410 million is 31 billion 410 million divided by 729 million 410,000. So you're getting the revenue per share, which is 43. Now let's go and divide the price per share divided by the revenue per share. and we get the value. So now when you look at this, you go back to your finance, type in the BMO.TO, and you will see the price per share there. In this case, or at the time when we did this video, the price was 133.25. Then now bring your revenue per share, which is 43. So you get 3.09 in this case, which is exactly the same amount that we got from the previous method. So same thing, you're paying $3.99 for per $1 of sale the company make. So it is expensive. It is expensive, and it might even go to $5 price per sale, or even $10. So it goes to $10 price per sale. It is really overvalued, and it's really very expensive compared to the value it gives. So maybe if this price per share goes to 1, and then you see this company is a good company and it's now undervalued, so it's cheaper, you can buy and still continue investing in this company. It depends. So we have been looking at this video, and we are now arrived at the limitation. So sometimes some things are good, but they also have limitation. So the PS ratio cannot be only used without incorporating other ratios, because it is not perfect. It does not show the profit margin. So it's just obvious, like every companies can make sale, they can make revenue, but the whole financial picture of the company, the profit has to be there, right? So maybe you're making sale, you're making revenue, but your liabilities are too much than the asset that you have, than the sale that you're making. So if you have that one, and then that company is not a good company. So you just have to look at the whole picture, not just only the price to sale ratio. It does not account for debt, just like what I have already said. So it doesn't account for debt. So you have to check the debt of the company, check the management, check the PE ratio, check other ratios that are needed for you to make the sound decision when you're making investment. Now let's go to recommendation. When you're comparing companies, you have to look at the one that has the lower price to sale ratio, because that one is undervalued and you would pay less for good value that you get back from that company. So you should not use price to sale ratio alone. You have to use it alongside other ratios like PE. The lower the PES, the better. This PS value cannot be manipulated, so use it all the time, but use it with other ratios and other factors that you need to consider before you make investment decision. And if you like this video, please subscribe for more videos, and I will appreciate your business. And thank you.